Right now, millions of people are participating in a legal system that systematically drains their savings while they believe they are building a future. We are taught that the market rewards patience, yet a different pattern plays out every day. Retail investors pour their life savings into assets at peak hype, while Wall Street quietly unloads those same shares right before the drop. To understand why experienced insiders survive while everyone else gets wiped out, we have to look at the specific mechanics used during the 2008 financial crisis. Losing half a portfolio at the exact wrong time is the intended result of an engineered system designed to funnel money from emotional amateurs to disciplined professionals. Hollywood depicts financial fraud through secret meetings and illegal manipulation in smoke-filled rooms. The reality is much more efficient. Institutions extract wealth by triggering the instincts hardwired into the human brain, paralyzing fear during market crashes and blinding greed during massive bubbles. These emotions make an investor's actions entirely predictable. In a liquid market, predictable behavior is the primary source of professional profit. The financial media acts as the engine for this cycle. Its business model relies on capturing attention through extreme sentiment rather than providing accurate market forecasts. By the time panic-inducing headlines reach the public, institutional money has already repositioned itself to capitalize on the reaction. During the year 2000 tech bubble, everyday people quit their jobs to day trade as internet companies with zero profits saw their valuations explode overnight. Reality eventually caught up to the hype. The Nasdaq dropped nearly 78%, wiping out trillions of dollars in wealth and permanently crippling the retirement plans of millions. This era established a primary rule for the smart money. Absolute public confidence serves as the most reliable indicator of imminent danger. The 2008 financial crisis escalated these stakes from a severe correction to a total systemic failure that destroyed homes and fractured families. Major institutions marketed risky mortgage investments as safe havens to their clients, while privately betting that those exact same assets would fail. When the underlying foundation of those loans gave way, it triggered a collapse that bankrupted massive institutions like Lehman Brothers and sparked a global panic. This chart of the S&P 500 shows the scale of the damage. The index lost more than half its value, plunging straight down from its previous peak. These investors were destroyed by their own trust in a system that viewed their Retirement accounts as a dumping ground for toxic debt. The market relies entirely on the biological flaws hardwired into the human brain. Rapidly rising prices chemically trick the brain into feeling like risk has vanished, while sudden collapses convince investors that recovery is mathematically impossible. History proves the opposite. Every major economic shock, from the Great Depression to the 2020 pandemic freeze, has eventually recovered. Still, the cycle repeats. Panic forces retail investors to sell at the absolute bottom, and hope tricks them into buying back in only after the recovery has peaked. Warren Buffett's strategy requires the opposite. His core principle involves aggressively buying quality assets at the exact moment the public begins to panic. Successful investing is a test of rigid emotional control rather than raw intellect. Social media platforms have weaponized this environment. Pure attention is now an asset class, traded heavily alongside actual profits and cash flow. The meme stock phenomenon demonstrated how rapid online hype, disconnected from business fundamentals, causes explosive overnight volatility. Wall Street adapted by deploying high-frequency trading algorithms that monitor retail sentiment across social platforms, reacting to human emotion in fractions of a millisecond. Human investors who rely on emotional reactions to social media hype are playing an unwinnable game against these machines. Survival in this environment requires a total shift in behavior, beginning with the removal of the casino mindset. Protecting wealth requires 3 rules: ignore emotional media headlines, focus on long-term timeframes, and prioritize business quality over temporary hype. The market operates on a single law. It transfers capital from the impatient to the patient. This system thrives on the predictable, highly profitable exploitation of human nature, rather than secret illegal backdeals. The stock market has generated massive historical wealth, but it reserves those gains for those who value discipline over emotion. The societal expectation that investing should be a fast-paced thrill ride keeps capital flowing into the hands of those who prefer it to be boring. When the inevitable next crash arrives, you will have to choose between the panic of the crowd and the discipline of the wealthy. If you want to understand how money actually moves, make sure you subscribe. The market ultimately rewards those who stay rational, while the rest of the world loses control.